So again, we want to thank you guys for joining us on the Zoom chat. We're going to try to do this every Thursday at 3 o'clock from 3 to 3:30. We'll make it short, 20 minutes, last 10 minutes, open for questions. As you know, Betty and I are a mother-daughter team. I've been doing this for about 21 years, and it's a crazy time right now that we're all living in. So we thought it would be important for us to have these because there's a lot of things that are on people's mind and they have a lot of questions. We'd like to introduce Peter Tressa. He's one of the lenders that we work with. His information is on the screen there if you want to jot down his phone number. If you have any questions, Peter's been in the business for about 20 years. So today he's going to be covering three topics that are affecting our market due to the coronavirus. So Peter, go ahead.
Well, again, I would like to just piggyback off Chantel, and I do appreciate everyone for taking the time to attend. I know these probably aren't exactly the most exciting webinar Zoom calls to be on, but we definitely appreciate you taking the time and show a vested interest in what's going on in the real estate market. So the three items of topic that I want to go over is first and foremost, the times that we're experiencing right now in regards towards the coronavirus, we're categorizing as an anomaly. It's definitely not something that we are experiencing that's recurring, that's happened before. So everything that's we're experiencing right now is not only a new challenge, but some of the issues that we're having, we're not able to find resolutions that are going to satisfy every single investor. So this is probably the most frustrating and complicated time, is because certain investors are telling us one thing, another investor is telling us something else. So there isn't like a universal blueprint in regards towards how we're supposed to handle this specific epidemic or pandemic. So I want to address the first thing is basically FICO scores. And that's what we're having the most immediate impact so far. Thanks, Sally. The most immediate impact we're having so far is regarding credit risk and credit rating. In the past, the most consumer-friendly product to get qualified for would be FHA. FHA stands for the Federal Housing Administration, and they allow you to put the least amount down if you're not a veteran, which would be 3.5%. And typically in the past, they would allow FICO scores as low as 500. All the investors recently have tightened up, and now the minimum FICO score is 680. And that now affects 75% of residents applying for a home loan in the state of California, I believe as of March 15th. So that's a pretty significant number. There are other brokers and banks that are soliciting and marketing that they can do those particular products below 680, but the interest rates are all over the place. So the safest bet right now is everything is contingent on each individual institution. Chase released a bulletin a couple of days ago that they're only accepting applications on clients that are putting 20% down with FICO scores at a minimum of 700. So Chase is one of the bigger players, and we're anticipating a lot of the other smaller banks to follow suit. But as of right now, we're subject to, again, a lot of uncertainty. So in regards towards credit, that's the immediate impact that they're having on our products, is that the requirements for credit are a lot tougher. And to qualify for that, like I said, 680 does not accommodate a huge majority of the applicants that we're receiving right now. So before I move on to the next topic, is there anything
what do you think, Peter, is the average, like if all the banks went a minimum credit score of 680 and 20% down, how would that affect the average? What's the percentage of our buyers that are under 6 or refinancing that are under 680 and have less money to put down?
Well, in regards towards, everything is really contingent upon the demographic and geographic. For me in particular, and every loan officer is going to be different, I do a lot of down payment assistant loans. So for me, that affects my business when it comes to the purchase market, probably about the same as the state average, which is about 75%. 75% of my clients have a below 680 score when it comes to FHA purchases. Refinances are a little bit different. Refinances, if you have a 670, 660 or so forth, and you have a lower LTV, you're going to be able to comfortably accommodate conventional financing. And those pricing when it comes to our market is incredibly gratuitous. Interest rates right now for conventional loans are still the lowest they've been probably in the last 10, 15 years. So now would be definitely would be an opportune moment to take advantage of that. In particular, if your score is above 680, the advantage is all around if you have above 680 score for purchases in regards towards the mortgage insurance in particular, is also going to net huge dividends in regards towards total payment.
So Peter, I have a question. Is because the government is the ones that make these certain bars to reach, right? Or the banks that support government loans. Who's the ones that are making this minimum FICO score of 680? And when or will there be an end to this, or is it indefinitely?
Well, as of right now, it's indefinite. We don't anticipate any imminent changes until we're all speculating that there's closure in regards towards the spread of this unfortunate virus. But in regards towards the reason why they're doing it, the U.S. government imposed these specific sanctions. Well, it's not really the government, actually. It's actually a lot of the major investors, Wells Fargo, BofA, Chase. The bigger banks are hesitant in bringing on this portfolio of products. And the most casual way to explain it to the average consumer is that if you have a below 680 FICO score and you're putting a minimum of 3.5% down, the probability of you being in a line of work where you're relying on paycheck to paycheck is considerably high. That's just the credit profile that we're accustomed to seeing when we are working with this particular set of borrower. So if you magnify that times, 100 me, which is 100 loan agents, 100,000 clients, it just enhances the risk exponentially for that specific loan. So what they're trying to do at this particular point in time is minimize the risk for the amount of buyers who are not qualified or who potentially can be at risk of not being able to make their first and second and third month mortgage payments. So what they're doing right now is kind of like a panic gut check. It's like, hey, we want to make sure that we're not funding loans for people who are either on furlough right now or who are potentially eligible to be furloughed at any minute until they find a cure. So what they're trying to do at this point is just basically minimize risk.
So one of the questions that came in over the chat to me, it said, do they anticipate loosening up credit requirements once the shelter in place is lifted for a while?
Again, that's the short answer I would, if I had to guess, I would say yes. But then there's a lot of different variances in regards towards how credit rating is going to be viewed. For example, forbearances is a common and popular word that's being tossed around in today's media regarding a multitude of financing, not just relative to specifically mortgages. So for example, if you are offered a forbearance on an auto loan, not every financial institution has the same criteria. So for example, if you have an auto loan with GMC and they're willing to give you a 3-month forbearance where you do not have to make a lump payment, and then Honda Finance says, hey, listen, we'll give you a 3-month break, but at the end of those 3 months, you have to basically satisfy all the payments at once, equivalent to that of a balloon. We don't know how that specific verbiage on the credit report is going to be interpreted in regards towards us as lenders. And we also don't know how that's going to have an adverse impact regarding the actual FICO scoring. So I think at this venture, it would be a little bit arbitrary and premature to suggest that those guidelines are going to loosen up, because we have yet to experience the moderate and long-term impact that this is going to have on people's credit profiles.
Okay. Thank you.
Should I go on to the next slide?
Well, I just want to go over a couple other things that are pertinent to our specific situation. Another safeguard that investors are incorporating to help prevent, again, moderate and long-term losses is that a lot of people who are being furloughed, at the end of the day, they're not basically saying, hey, we're not going to fund your loan if you are being furloughed. There are alternative guidelines to help people actually qualify for the home if they can. So for example, if you have 2 borrowers, one borrower works for the prison, they're making 160 grand a year. You have another, let's say their spouse is working at Target, they're furloughed. As long as you can qualify on government assistance and the other borrower's income, they are allowing those transactions to close if in the event you are, if one of your, one of the borrowers are part of that furlough unemployment group. So that's good too. The other immediate difference that we're noticing that's going to have a direct impact on our buyers is the capacity for appraisals. And I think that's the biggest thing, in my opinion, for buyers is that if a buyer is not able to actually go and inspect the property and have a cosmetic perception of what they're purchasing on the inside versus just the outside, I think that's going to limit and minimize the amount of interest and the amount of buyers that we're going to have. We as lenders are allowing our purchase transactions to close on just a drive-by appraisal, which means the appraiser is going to assess the value based upon just their cosmetic condition of the property alone without actually inspecting the property inside. And I think that's going to be incredibly hazardous for a majority of buyers to be able to be put in position where they can potentially close but not have the opportunity to go through a final walkthrough, or even worse, not be able to inspect the property inside in itself. So we don't anticipate or expect that to continue, but as of right now, we are allowed to close on purchase transactions with the drive-by appraisal. But again, these are just another form of the times right now where—
What about VA? Because you know VA has certain requirements
yes,
for
that's actually
appraisals.
that's a great question, Chantel. So in regards towards VA appraisals, from what I've been told with us, and this is relative to our bank, they are required to actually go inside. And that's a really good point you bring up, because along with the appraisal for VAs, we also require a home inspection. We need to have a termite report along with Section 1 clearance.
Oh, so you on VA, they require a home inspection too?
I'm sorry, a termite report. That's what they, sorry.
Okay,
they require
report.
a termite report. I apologize.
Yeah.
So they require a termite report with Section 1 clearance, and a lot of times, so we had one VA loan last week where the tenants did not grant access to the actual inspector. So again, that's going to be relative to each investor specific and an own individual guideline. And that's the one area that all lenders are trying to get a grip on, is that we don't have a universal blueprint where we can say, hey, you know what, we're all abiding by this criteria. Every investor in particular, and every banking platform, every mortgage company, we're doing our best to interpret a very vague scenario, but on a broadened scale. And we're trying to identify, in every bank, what they're basically trying to do is minimize risk for the next 90 days. And that's optimistic on their part. You know, they're assuming that within 90 days, we're going to have this under wraps. So again, anything that we put out is going to be subject to change. We've had guideline changes in regards towards credit scoring and verifications of employment up to 3 times in one day, where last year we only had that policy change once. So
talking about the credit, I have a question. So if somebody wanted, this also affects people who refinance too, or just purchases?
It's affecting everyone.
Okay.
Yeah.
So if somebody had a FICO score of 660 and they needed to get it up to 680, is that something that a lender could help them with? As far as, is there things they can do to improve their credit score?
Yes, so that one's a little bit tricky. So our guideline is, from a banking standpoint, we cannot manipulate the credit in an effort to induce and strengthen their credit profile before an underwriter reviews it. And if you're not familiar with our industry, that can sound a little bit intimidating. So the short answer is yes. If I look at someone's credit profile in regards towards pre-qualifying and I see they're at a 660, 665, and I notice that they have 3 credit cards with high balances that are reaching their high limit, I can advise them. And I can say, listen, as of right now, you do not qualify. However, if you do pay down your debt and we repull your credit in the form of a rapid rescore and you're able to acquire the 680 score, now you're eligible. So if we follow that blueprint, then yes, we are able to educate and provide suggestions on how they can induce their credit and strengthen their scores. The trick is, and this is the main principle regarding that, we cannot pull credit, submit the file, and then the guideline change, and then we induce the FICO scores so that way they qualify. So that's where it gets tricky. So let's say, for example, Chantel, you have a buyer, they have a 680 FICO score, we got the loan approved, and then let's say tomorrow they increase the guideline from 680 to 690. I cannot legally advise them on how to induce their score to qualify because the underwriters already reviewed their credit. Now, what I can do is cancel the file because they no longer are eligible, meet with them again and say, hey, listen, in order for you to qualify now, you would then have to either pay off debt or follow other alternative instructions on how to strengthen and increase their FICO score.
Mm.
So that was a little tricky. So the short answer is yes, but there's specific procedures that we have to follow.
Mm. Okay.
Can we touch a little more on the funding limitations?
Yeah, absolutely. So in regards towards like the funding limitations, I mean, everything right now is on a case-by-case scenario if you fall under certain titles of employment. For example, I have a really good one. I'm refinancing a realtor right now. Her FICO score is below 680. It had to go in front of an executive committee, which is pretty common right now in our industry. Luckily for me, we're a smaller company and our committee consists of 3 managers. Well, I mean, I'm part of the committee too, but I was unable to obviously cast my vote. But she's self-employed, she's a realtor, but even though she's categorized as an essential employee in Monterey County, Fannie Mae disqualifies them as a essential employee. What our bank stated, we're willing to take the risk and fund this loan if we can provide 2 compensating factors. The 2 compensating factors that I was able to provide is, number 1, they've never showed or demonstrated a history of being derogatory or delinquent on their mortgage. And 2, there was a significant amount of reserves. So for whatever reason, they came across hard times, they had about a year's worth of payments that they could make. It is imperative that if someone is potentially eligible to apply for forbearance, we're going to discontinue that funding altogether, because if we fund the loan and a borrower applies for forbearance immediately after, smaller banks like us who do not service those transactions are required to keep that loan on our warehouse line, and that it would be incredibly problematic for a bank smaller like us. So we as a smaller bank have a lot of advantages in regards towards flexibility, more aggressive underwriting, and we're typically faster. But this is where being a smaller bank is against us, because we don't have the net capital to incorporate or keep like $15 million on our warehouse line for an extended amount of time. We are a bank, we fund our loans with our own money, but immediately after, within 30 to 45 days, we sell them to various investors, whether it be Wells Fargo, the money store. I mean, we have about 50 to 60 investors that we sell them to regularly. However, if we have to keep a loan on our warehouse line for an extended amount of time, that immediately minimizes our capacity to be able to fund what we normally do, which is around $200 million a month. So if we have 100 million.
Isn't that called the secondary market?
Yes, it's called the secondary market, and every bank's different. We're a correspondent. We have a warehouse line for, I believe our limit's $200 million, which we flip twice a month, which means we can fund up to $400 million. However, if we have $100 million in loans based upon clients who apply for forbearance, now we only have $100 million of capacity, and that's 50% of what we normally have accessible to us, which would significantly hinder our ability to function accordingly. Now, a company like Stearns, obviously Bank of America, Wells Fargo, they don't have those type of problems. However, they're also, even though they don't have warehouse line capacity issues, they're also a lot more conservative.
Yeah.
So,
Well, just like Chase raising the minimum score to 700 and minimum down payment 20%.
no,
Or like you were
absolutely.
saying, your board approving based case by case. Wells Fargo
Yes.
doesn't really do case by case. They're more, here's what we require. There is no exception to that.
Absolutely. Well, I mean, there's always going to be exceptions, but those exceptions need to be backed up by compensating factors. But I mean, just take in consideration, I mean, a 20% down 700 FICO score, the probability of that being a first-time home buyer is pretty slim to none. That's typically a client that's either selling their home, upgrading to a bigger house, and in that particular scenario, you're going to have to find someone to actually buy their home now. So the ripple effect on that still hasn't been, we can't truly appreciate the magnitude of all these changes probably until maybe May or June. But like I said, that criterion itself is a little bit misleading, because the average consumer could probably be like, yeah, there's probably still a lot of people out there with 700 FICO scores putting 20% down, which is true. Let's just say there's like 100 of them right now, but the 100 of them who are eligible to buy new homes, they don't have people eligible to buy their departing residences. I mean, it's been a long time since I've had a first-time home buyer putting 20% down with a 700 FICO score on their first home. I mean, I really can't remember the last time I've actually had one of those.
So we're getting close to time. So we kind of went over what and why. Now maybe we should go over how. So if they want to apply for a loan, or they're looking at getting, what's the next process?
Well, the next process, regardless if you're applying for a home or you're waiting for the market to improve, I always recommend to people start the process early. Get all the documentation that we as loan agents need to succumb to and render a decision of whether or not the person's approved. And even if they're not approved now in April, doesn't mean they can't be approved in June or July. I mean, a lot of times what it comes down to is just being able to knock away some of that debt, so that way, you can get your credit score to the point where you're now eligible for today's guidelines. So the first and foremost, in any scenario, in any climate of weather, any climate of where our society is, you always want to get pre-approved first, because without at least getting some sort of direction as to whether or not you're capable of buying now, 3 months from now, or even a year from now, you're never going to know unless you sit down and talk with a lender and get a full synopsis of what your individual situation is.
Is there anything you wanted to touch on these slides that you sent me, Peter?
No, so those slides are pretty self-explanatory, and I think, in my opinion, I think we're better off maybe designating another time to go over both those three things if you want to open it up for a question and Q&A. But I mean, like, just that first slide alone, that'll probably take 15 to 20 minutes, and I know people have different schedules. Well, I'm just being honest. I can go in depth, and anyone who's on this conference call, they're more than they're more than welcome to text or call me today. I'm normally here till like 8 or 9 o'clock every night anyways, and I can go over that in detail if it's an immediate pressing matter, but that'll take about 15, 20 minutes.
So we got one question. Can someone refinance if they are in a forbearance?
No. So with our bank and the majority of financial mortgage companies that, because I receive bulletins from a significant amount of banks out there, the majority is going to be no. So for us, if we even have someone borderline potentially that could be ineligible for a furlough employer, we have them actually sign a disclosure indicating that they do not intend, nor will they apply for forbearance after it funds. So if we fund a refinance in April, their first payment is going to be due in June. Although we can't enforce it, we still have the borrower sign or write a letter of explanation indicating that they do have every intent of continuing to make their mortgage payment. And that's the reason why if someone doesn't have reserves and they're below that 680, that credit profile will get presented to our executive committee for a majority decision to render of whether or not we're going to take that risk or not, because again, we're a smaller bank. But the short answer is no. I would say if 9 out of 10 banks, if the originator identifies that they either are in a forbearance or they're possibly going to apply for one, that would immediately and instantaneously disqualify their eligibility for a refinance.
So we discussed last week on forbearance, and we had another lender on here as a guest, and I just kind of want to get your thoughts on it. We don't know how they say that it won't affect your credit, but I think it's premature to tell. What's your thoughts on it? If somebody does a forbearance, how do you think that's going to affect their probability of refinancing 6 months, 12 months down the road?
So the verbiage in itself, it's kind of like a short sale or foreclosure. The short sale verbiage and the foreclosure verbiage on the credit report, that doesn't have the immediate adverse impact on the FICO scoring. The verbiage is what we use as a lender to identify the seasoning guidelines. So if someone applied for forbearance in April and they got approved, and we know that it's a 90-day forbearance, not every bank is following, again, a universal blueprint on how the terms and conditions of that forbearance are going to be. Some lenders are stating that after 3 months, the 3 months worth of mortgage payments that were in the forbearance program are going to be due along with the fourth mortgage payment altogether. Some banks are going to spread out the forbearance over a 12-month span. So to simplify it, if your mortgage payment is $1,000 a month, you have 3 months worth of forbearance, which you take advantage of. The fourth month, you're basically going to have to come up with $4,000. The 3 months of the $1,000 mortgage payment, along with the one that's currently due. Some investors, what they're doing, they're going to be like, hey, listen, after the third month is over, instead of you paying $1,000 on the fourth month, maybe you pay $1,500. They'll spread it out. So that's why the interim response is that if you are in forbearance or you have applied and gotten approved for forbearance, the probability of you being able to qualify for a mortgage right now is going to be very slim to none, because we don't have the terms and conditions of that forbearance, nor do we see or we can predict how that's going to affect.
Well, how do you think it's going to affect the credit 12 months down the road? Because for example, a mortgage late, right? You have a mortgage late and you have a late on your car payment. Before all this happened, okay, before coronavirus, how did those two things affect your credit? Because it was my understanding that you're better off having a car payment late, a 30-day late on your credit, than a mortgage late.
You're better off having a car payment late on your mortgage only when it comes to satisfying the seasoning guidelines. So for FHA, I believe you can have more than 2 lates within a 12-month span. But they both have the same damaging.
Oh, I thought it was like a 2-year for a mortgage late. I thought that was more serious.
No, I mean, no, we can have a mortgage late last month and still close on a refi or even a purchase.
Okay.
But the way they formulate how that's going to have a negative impact on your score, there's a portfolio of factors that will determine to what extent that's going to negatively impact your credit. So to say missing a mortgage payment, I mean, in my opinion, based upon my extensive history of being able to read credit reports, it doesn't matter if you have a $10 late fee with Target, a $700 car payment, or a $3,200 mortgage payment. If you are consecutive or even have a one-time late or a repeated pattern of being delinquent, your credit score is going to be affected negatively, actually quite significantly. So in my opinion, it doesn't matter if it's a car, credit card, or a mortgage payment. If you're delinquent, it's going to affect your score immediately and instantaneously. Now, the difference between the two just basically has to do with seasoning. You can be late on a car payment 8 times. As long as your score is 700, which would be unlikely, you would still qualify and be eligible for a mortgage. If you, for whatever reason, were delinquent on your mortgage 4 times out of in 1 calendar year, you're not going to be eligible for a mortgage regardless of what your FICO score is. So that's the difference between the two.
So it is more serious to have a mortgage.
No, it's a lot more serious in regards towards seasoning.
Okay.
So for example, like if you foreclosed on a house 3 years ago, you're eligible for FHA financing, today. If you missed like 10 car payments 2 years ago and your score has been able to recover, you're eligible for financing immediately as long as your FICO score substantiates what the guideline requires.
Okay.
But I've yet to see someone that has like 3 car payments that are late that has higher than a 680 score, especially within a 12-month span.
Okay.
But some people have that credit depth, and if they do, more power to them.
Well, this is good information. Thanks, Peter.
No,
So does anybody have any other questions? I just want to kind of put it out there and ask even Peter, your opinion is valuable. If you guys want to shoot me a text or a chat telling me what are some other topics that you're interested in hearing about, especially things that are affecting us right now due to the market. We're looking at doing other topics because we'd like to do this again every Thursday. And Peter, we hope that you come back and join us again and maybe talk about something else on another chat day.
No, it'd be my pleasure.
All right. Well, thank you guys for joining, and we appreciate it. Thanks, Peter.
Okay, thanks, Chantel. Bye, Betty. Thanks, everyone.